Right now, silver is sitting at $61 an ounce. And most people look at that number and feel nothing. They scroll past it, they move on. They go back to watching tech stocks and crypto tickers, chasing noise while something far more structural quietly builds beneath the surface. But there is a group of people, commodity strategists, sovereign wealth managers, institutional analysts, who've spent careers studying metal markets, and they are not scrolling past that number. They are circling it, because $61 isn't just a price, it's a compressed spring, a market sitting on top of fundamental forces that have been building for years. And the question isn't whether those forces are real. The question is whether you understand them before the rest of the market catches up. Let's start with supply, because this is where the story gets genuinely uncomfortable for anyone dismissing silver as a retail investor fantasy. The Silver Institute has documented consecutive years of structural supply deficits. The world is consuming more silver than it is producing, not slightly more, meaningfully more. Global mine production has been essentially flat. New mine development takes a decade from discovery to first output. There is no supply surge coming to relieve this pressure anytime soon. And the demand side? It's transforming in ways the mainstream financial media is dramatically underestimating. Every solar panel requires silver paste in its photovoltaic cells. Every electric vehicle contains silver in its electrical architecture. Every advanced semiconductor, the chips powering the AI revolution everyone is talking about, requires silver in its manufacturing process. The two dominant capital expenditure themes of this decade, artificial intelligence and the energy transition, are both structurally silver demand stories. You cannot separate the AI economy from the silver market anymore. The physical requirements are too deeply embedded, and silver at $61 has not yet priced this in. Here's what most people completely miss about this market. Silver trades in two separate universes simultaneously. There is paper silver, futures contracts, ETF positions, synthetic exposure that Wall Street sells to investors who never touch physical metal. And there is physical silver, the actual bars, the coins, the industrial feedstock sitting in the warehouses of solar manufacturers and chip fabs. For decades, the paper price has set the physical price. Large institutions have managed silver's price discovery through the futures market in ways that would be impossible in a purely physical market. But when the gap between paper pricing and physical availability widens far enough, markets correct, sometimes slowly, sometimes violently. The gold to silver ratio is currently sitting near 54 to 1. Historically, that ratio has averaged between 15 and 30 to 1. What that gap tells you is that the market is still pricing silver primarily as an industrial commodity, not as a monetary metal with extraordinary and accelerating industrial demand. That mispricing, when it corrects, tends to correct with force. Now layer in the macro picture. The Federal Reserve is navigating one of the most complex monetary environments in modern history. Persistent inflation, a balance sheet that expanded to nearly $9 trillion, and a political environment where Fed leadership itself is under scrutiny. Figures like Kevin Warsh, who takes hard money principles seriously and has been openly critical of balance sheet expansion, represent a school of thought that, if it gains influence, could reshape real interest rate expectations in ways that directly benefit hard assets. Silver is hypersensitive to real interest rates. When the market begins to price in rate cuts or a softening of the Fed's inflation-fighting resolve, silver moves. It moves fast. The setup at $61 in an environment of structural deficit, industrial transformation, and monetary policy uncertainty is the kind of setup that analysts spend careers waiting for. The last time a convergence like this aligned around silver was 2010. The metal went from under $20 to nearly $50 in 18 months. Today's industrial demand story is larger. The monetary distortion is deeper, the supply deficit is more entrenched. The math of where this could go, if the thesis plays out, doesn't need me to hand it to you. You can do it yourself. But I want to be honest with you, because credibility matters more than hype. Silver is volatile. A market that moves up 30% in 3 months can move down 20% in 3 weeks. In a sharp, risk-off environment, silver does not always behave as a safe haven in the short term. The industrial demand thesis, while structurally powerful, is subject to execution risk if global growth slows. And the Fed has demonstrated a consistent willingness to hold policy tighter for longer than markets expect. The silver thesis, even if every fundamental element is correct, requires a time horizon measured in years, not months. It requires position sizing that lets you hold through volatility without being forced to sell at the wrong moment. There are no certainties in financial markets, only probabilities, time horizons, and discipline. The people who built real wealth through commodity cycles were never the ones with perfect information. They were the ones who understood a fundamental story early, sized their positions with conviction and patience, and held when the market tested them. Silver at $61, with structural deficit data, accelerating industrial demand, and a gold-to-silver ratio implying significant undervaluation, this is a story hiding in plain sight. The question is never whether the information was available. The question is always whether you were paying attention when it mattered. Drop hold in the comments if you're watching the physical market. It tells me where this community stands, and it helps this analysis reach the investors who are thinking seriously about what comes next. Because the biggest moves in financial history were never made by the loudest voices. They were made by the quietest minds.